Perfect. Well, welcome everyone. My name is Brad Ahrens. I'm with CRE Investor Coached, and I am thrilled to have you here today. If you're in the world of commercial real estate investing or looking to break into it, you know that success isn't just about finding the right deals. It's about having the right mindset, strategy, and guidance to navigate this complex environment, which is exactly why I created CRE Investor Coach to create a tool to not only create solid foundations for future growth for both new and seasoned investors, to help you guys gain clarity, confidence, and a competitive edge. And today we're going to be talking all about markets, right? Market cycles, fundamentals. We have found that a lot of investors, think that they understand the market or believe they know where the market is going. But a lot of what we do at Investor and Coach is trying to get out of the mindset of I think or I believe and being able to quantify those statements. And I'm also equally as excited. We have a special guest, Bo Barron. Bo Barron is a couple things to me. He is not only a CCIM instructor, specifically focusing on markets, market analytics, but outside of Investor Coach, we also manage together a private equity fund called Hearthstone Capital. So not only a trusted colleague, but actually a partner. So, Bo, if you wouldn't mind just taking a couple of minutes, doing a quick introduction on your background, and then we'll get this started.
Sure. Yeah, I grew up with parents in the real estate business, so it was just sort of part of the DNA of the family. I wanted nothing to do with it. Ended up in the Marine Corps, but when I got out, I started working with my dad the very next day, and have been in commercial real estate in one way or the other ever since. So I'm a commercial real estate brokerage owner. I'm an investor and a syndicator. Like Brad said, I'm a senior instructor for the CCIM Institute teaching 102. So if any of you have had 102, you understand that's all about market analysis. And yeah, partner in Hearthstone out of Western Kentucky. So that is a very brief snapshot of me. And man, I'm happy to be with you.
Yeah, happy to have you. So we've got a couple goodies for y'all today. The first and foremost is we do have a workbook that you guys can download and take as a takeaway following today's session. All right. So also some other rules once chat has opened up or the Q&A has opened up. If you guys have any questions at any point in time, this is super interactive. It's here for you guys. So feel free to ask a question in the Q&A or in the chat. We've kind of got some different pauses throughout this session to make it more interactive. So if you guys have questions, lob them out. We are happy to go through those as well. All right, so let me ask you this, right? As a CCIM 102 instructor, specifically focusing on markets, market analytics, what does it mean to you to better understand real estate cycles and overall fundamentals?
Well, anytime you look at a market, and mostly what we're talking about is not your market. So if you're looking at a piece of property and you're thinking about investing or you want to advise on it or whatever the scenario is, and you need to learn a market, what you're looking at is everything from economic base analysis to shift share analysis, but mainly job growth.
Okay.
Job growth drives everything. Jobs equal people, people equal demand for all types of space. So if you can
Okay.
quantify that, you can predict the demand.
Okay. Okay. But using that information, right, how can you take that to start to analyze, predict, right? Because I think we'll kind of go through this in a moment, but to some degree, when you look at typical reports or submarket reports, they normally have a 90-day look back, 90 to 6 months of looking back of what has happened. But if I'm an investor and I'm underwriting an opportunity, typically I'm underwriting out 5 years in the future. So how can I begin to better understand a market and kind of where it is in the cycle and some key fundamentals based upon what's happened in the past to predict what's going to happen in the future?
Well, what happens in the past gives you a baseline for certain multiples. And you can take what's happening today, apply those multiples. You make the assumption that those multiples are going to basically stay the same, and then you can start to predict the future. And so if you understand how the market cycles flow, that really gives you the context to analyze that data and make informed, wise decisions about what you'll expect the future to be, as
Okay.
opposed to just guessing or my gut says or
Right.
gambling, as you put
Right.
it.
Right. Because you think about it, and I'm sure you've heard it. I hear it all the time, especially when I'm talking to, like, let's say we're looking at a deal in another market that's outside of our hometown. And as you start to kind of do like your desktop review to see if it, makes sense to explore further, you would normally at some point engage with kind of a local boots on the ground expert. That could be brokers, financial advisors, different folks who are in that market. And I hear all the time about like, hey, like where are you in the cycle? What's happening? Where are you going? And so many times I hear, well, I believe, my gut's telling me this is where it's going. But if you're formalized enough as an investor, let's say where you have partners, major investors, or even an investment committee, how do you go to committee and basically say, hey, I think this is a great location to be in? The experts on the ground are saying they think it's great. But are you willing to invest multiple millions of dollars based on a I think, right? I don't know about you, but boy, I'd feel a lot better if someone was to actually say, "Hey, here is some quantifiable analytics to support my I think to this is the facts. This is a snippet in time today based upon these fundamentals. This is where we are going." Right? So part of what we're going to talk about today is just kind of giving y'all a different way to think about markets, market cycles, supply, demand, velocity, and everything we do at Investor Coach, right? Because obviously there's so much information, there's so much to be learned, even in your existing market to a new market, that everything we do is kind of taking it from a funnel, right? Kind of starting with some macroeconomics and whittling it down so that at every decision stage, you're continually kind of going like go, no go type scenario, like macroeconomics makes sense. Now I'm narrowing it down. And now I can almost even narrow it down to zip codes, lot and blocks on a specifically where I want to invest. So I think to do so, right, we got to first talk about the four market cycles. Bo, do you happen to know what those are?
I do. And luckily, they're right in front of us too. But
Right in front of your face.
you've got recovery. All right. Recovery is basically a time where there's not a lot of new development. All right. You've come out of a period where you might have even had negative rent growth, uh, but demand is starting to catch up with the supply that's in the market. And once it sort of pops through your long term average occupancy for the market, you go up into the expansion phase. This is where it becomes economically feasible again for developers to add new supply to the market. Rents are growing up rapidly. You're starting to see a lot of growth. Deals are happening. Transactional velocity is going to increase at this point. And that'll go all the way up to this equilibrium point where supply and demand at this point are basically not evil, equal. And I generally think about this as the unicorn moment because does it ever really exist? Do you ever really know in real time that you're at equilibrium? I would submit to you that you don't. And what developers are great at, and we all understand this, is since they don't understand where equilibrium is, since you can't figure that out in real time, and since you don't know what your competition's doing, they overbuild. So if rents are going up and the demand is there, developers will add more supply to the market than is needed. Happens every time. And because the market cycle is years long and it takes so long to add new supply to the market, they overbuild. That puts you into a hyper supply. You'll still have rent growth in hyper supply, but the fundamentals of the market are going to weaken to the point where it ends up dropping off into recession. And this is where, and you don't want to be completing your project and adding new supply to the market in the recessionary phase. That is
Right,
negative rent growth, all that. It's no fun.
right. So on average, a typical real estate cycle is how long? Typical.
And 10-ish years, 10 to 12 years.
Okay. Might argue that it might be 7 years on a typical cycle, right? For
It,
anyone who's been in real estate since 2010, you realize that taking out COVID, which I believe was a minor blip in the market, it wasn't an actual correction. We have been in arguably, right, a cycle for the last 10, 12, 13 years. I'd say in the last year, year and a half, we've started to see corrections with oversupply, vacancy rates to certain categories in certain markets. But this current correction, which you may or may not call it, has been relatively minor compared to the correction of '08, right? That one was almost complete financial collapse, and it took us a few years to get out of it. So I've got a couple things for you guys to look at. So it's interesting as you do talk about the different four phases of recovery, expansion, hypersupply, and recession. When you talked about equilibrium, here is an example put on by the Mueller Institute. Obviously, this dates back to 95 as just an initial visual aid to kind of help you understand where long-term occupancy and the equilibrium is. But I feel like there is some discrepancy, maybe that's not the right word, of how this is laid out to kind of understand like a full cycle, right? Because it never, between recession back to recovery, it kind of never completes the full cycle, right? It's almost more of a bell curve on a X and Y axis. But to Bo's point, right, you can see some different indicators of what's indicated or involved in each cycle. There's also another great report that is put out annually by a real estate company called Integral, and I will show you that example here. They put this out every year, and it does break down different markets. I think it's the top 25 or 50 markets, and then also breaks it down based upon asset class. I think in this report includes industrial, multi, office, and retail. So one thing I see all the time is, and taking half a step back, so for developers and ground up construction, if I'm kind of in that thesis of, it could take anywhere from a market cycle is typically 7 to 10 years, right? For ground up development, think this through both from your perspective between identifying a site, tying it up, finalizing entitlements, beginning construction, and going through lease up. On average, how long would you say that process takes?
Oh, that's 2 to 3 years. Easy. Could be much longer depending on where you are.
Sure.
So we've talked about this in the past. Where I live, I can go get a permit, and 30 days later, I can be under construction. That can take a year or much longer depending on where you are. So that certainly plays into the equation. But there's such a lag. It takes years to add new supply.
Correct.
Yep.
Correct. Now, for some of those in maybe other markets that aren't as pro development, I mean, pretty common. It could take 2 years for entitlements, 2 years for construction, and 2 years to lease up based upon product type. So now I'm 6 years in on what could be a 7 or 10 year cycle.
Yeah.
So boy, you really got to think about, I mean, a lot of people right now are kind of, more interested in ground up development because they see us kind of coming out of hypersupply into recession and kind of riding that wave for continued appreciation and growth. But for that to really work, you've almost got to begin your plans and entitlements when the market is telling you not to develop, right? So very contrarian on how to proceed. Plus part two, how do you get your lenders and equity comfortable to get started on development when a market may be anti-development? Nothing's indicating, right? But you're forward looking, right? 5, 6, 7 years out. The other thing that's always interesting about market cycles is how it can actually assist you with your acquisition. Because we're a big believer that frankly, there is opportunity to acquire in every cycle. So arguably, if I'm looking at industrial, right, a majority of markets per this report indicate that we are at some stage of hypersupply, right? And as you guys can see, some of the characteristics of hypersupply, increasing vacancy rates, moderate to high new construction, low to negative absorption, and moderate to low employment growth, mid to low rental rent growth, right? So a lot of things are kind of saying, man, reel back. But Bo, like if you were looking at, just say example, Charleston, South Carolina, they're in the middle of hypersupply. You've got a great deal. what might be some mechanics of underwriting that you would insert to mitigate risk as you move to recession and then into recovery?
Well, as you're underwriting, you're going to want to, depending on your leasing situation for what you're purchasing, like you're going to want to build in more vacancy. You're going to want to build in more time for lease up because demand should be lower and there's going to be more competitive space in the market because vacancy is higher. So tenants are more, they have more options and you're in a competitive environment with other owners of real estate to win tenants. So it's a tenants market in this kind of scenario. So you have to build that in to your underwriting. Lease terms are also a big deal. Tenants want long-term leases at the bottom of these markets. In hypersupply and recession,
Hang on. Why?
because coming out of that, you're going to have significant rent growth, is what you would expect. And so they want to lock in a longer term at the bottom, quote unquote, the bottom of the market. Landlords on the flip side are going to be, or should be, if they understand market cycles, should be more willing to do shorter term leases because they want the renewals once we get into recovery and expansion so they can take advantage of the increase in rents. So that really plays in to your underwriting, to how you would project and look at a deal.
Right, right. Because most people have heard this saying, right? Buy low, sell high. But if I'm looking at a snippet in time that's 6 to 12 months in the past, and to your point, right? I mean, you can forecast and predict, but you're never probably going to hit it within a day or a week of when you are truly at the bottom of the market, right?
True.
Unlike the stock market that gives you instantaneous feedback on what's going on with stocks and bonds and so forth, real estate has a lag.
And
Even
it's opaque. Yeah.
Yes, exactly. Even if I'm trying to buy low, sell high, right? I mean, unless you get really lucky and happen to buy exactly at the right time, it's all about mitigating risk so that as, if you are at the bottom coming out, yeah, there are probably a few dials that you can turn within reason, right, to kind of expand on that growth. If you're in a down cycle, right, have to be able to hopefully buy it right and then make the appropriate adjustments to your underwriting depending on how long your hold period is to compensate for what could be a decline. But if you are ahead of it, right, or you have padded, right, enough of those assumptions in a downward cycle, then instead of like what we're seeing right now, I mean, there is a term that's trickling through the market right now called, I think it's a tsunami of loan maturities.
Mm-hmm.
And it really
The
has to deal
tsunami
with
wall.
the tsunami wall for a bunch of people who probably purchased right around at almost the peak of the market with short-term bridge financing that's going to expire in 3 years. And for all of you in the industry, you're starting to hear that, hey, valuations from 12 to 24 months ago are not what they are today. And if you have a debt component coming due, and it's still based upon LTVs, LTCs, DSCR hurdles, a lot of times those lenders are reanalyzing those assets and are not willing to refinance what you owed. And so there is a gap between what fresh debt will come in at and what you currently owe. And that is compensated with equity. And so if you weren't paying attention to where we are in the cycle, you should have never put that short-term financing on there. Or you should have valued that the asset may have been worth less, right? Because there's so much stigma in the market that, oh, it's real estate. It's always going to appreciate no matter what, right? It's always going to appreciate 2 to 3%. And for all of you who may or may not own commercial real estate, look at your homes, right? Your homes is not this linear line of growth. No, it goes up, it goes down, it goes up, right? And depending on where you have to sell is going to determine what your home or asset is worth. But it's all about making smarter decisions based upon known facts so that you don't do something just because I want it. I want to buy it. I need this deal. That all of a sudden, 2, 3, 4 years down the road, it's a lot easier to say no to a deal during due diligence than to be in a deal and all of a sudden you're trying to navigate some pretty turbulent times.
If I could interject, there's a couple
Absolutely.
things about the concept of a market cycle that's really important. It's almost irresponsible to underwrite a deal without the context of understanding where you are in a market cycle. Because the thing with the market cycles is it flows like a river. It moves from recession to expansion to hypersupply to, I'm sorry, recovery, expansion, hypersupply, recession. It flows in that direction. What you can do with the river, though, did you ever do this when you were a kid, Brad? Like take like an M80 or something and light it and have it explode like in the water? For a brief period, the water flowing one direction will go the other direction because of something explosive that happens in the environment. For just a brief moment, it'll go the other direction. That's what happened to the market cycle during COVID. Something exceptional, explosive in the environment caused the market cycle flow to go the other direction. And so you saw recovery back up into recession with certain property types in certain markets. And so there can be things that cause it to go backwards for a short period of time, but it always flows in one direction, essentially. So if you know where you are now, allowing enough margin for error to allow for the things you can't anticipate, like a COVID or some other explosion in the environment, you can anticipate and predict, not to the month, but eventually after every recession, there is a recovery. After every recession we've had, 100% of the time there's a recovery. You can't necessarily predict how long that'll take, but it's coming. And so if you know where you are in the market cycle and you have good data and you can analyze well, you should be able to contextually predict where we're heading next in the market cycle, which gives you a tremendous amount of ability to forecast demand. And if you can forecast demand, you can make money in this business.
Correct. Yep. Great point. All right. So we got one question from James. Do you think this correction has been mild because it has not yet fully played out? So Bo, I'll let you start. I got a response to that as well.
I do not think it has fully played out. Brad mentioned that this tsunami wall that's coming of debt and what we're going to do with that, like how that's going to play through the market. You've also got all this talk about the privatization of the agency debt, Freddie and Fannie and all that. They provide a tremendous amount of liquidity to the market. And so depending on what happens, or I seem to think that privatization is going to happen. So depending on when that happens, that's going to be one of those explosive environmental things that can rock for a second before that normalizes out. I generally like the idea of privatization, but it's going to hurt for a bit and it's going to affect access to liquidity and it's going to affect market velocity, like transactional velocity for a period of time. So yeah, I think we've got some more pain coming. I'm not sure that we're going to be able to look back and say this was mild. I think there's going to be a tremendous amount of opportunity for people who are well capitalized and can mine for basis and make really great buys, because I think there's going to be a little bit of a bloodbath still to come.
Yep. I think if I would expand upon that is James, if you would have asked me this question, let's just say 12 to 16 months ago, I would have forecasted that tsunami of loan maturities, you would have started to see more of it. But what a lot of lenders have done is that they have realized some of the issues in the market and kind of where we are in certain cycles, and they have been much more willing to work with borrowers on restructuring or extending their loan, resetting loan covenants, resetting, NOI covenants, DSCR hurdles, so that they're kind of playing along with you. But banks make money by recycling capital, right? Redeploying, collecting interest, redeploying, recycling capital. And there's probably a number of assets that they have loans on that they had anticipated getting off their books in 2023, 2024, but they've hunkered down with borrowers. They're kind of riding that wave. But most loan extensions as of right now is somewhere between 6 to 12 months at the longest. And I don't foresee them being able to continue to kind of blend and extend for another round. There's going to be a point in time where, similar to, I think, elements of 08, 09, 10, where there's going to be not as much restructuring, more of reevaluating those loan amounts, bringing those values down, and now really putting a sponsor or a borrower in a pinch of not willing to blend, extend, move forward. And now I've got to fill that gap between my current loan and maybe some refinance or disposition options. So, all right, we got another question. How will this one differ from the last extend and pretend? Interesting. Bo, you want to tackle that one?
I have no idea. I just don't know. It's going to have a lot to do with the dynamic Brad was just talking about. Like, how much flexibility can the banks afford to do? Like, how long can they extend some of these really low interest rates when if they could call the loan, get that money back, recast it out at much higher interest rates? Every time they extend, they leave a lot of money on the table. But their alternative is they're going to own the real estate in a lot of these cases, which they definitely don't want. So I don't know how to forecast that out.
Right. I mean, I know to some degree, some lenders are so flexible enough, right? They're not looking for any sort of buy down. They're resetting all of your covenants, depending on where you are, kind of from break even to stabilization. And probably even more importantly, is that they're not really pinching the borrower on that extension fee. We've seen it as low as, let's call it 10 to 15 basis points, up to maybe as high as 25 to 30. Obviously, depending on your lender and some criteria, but they're playing ball right now. But they're an institution. There's only so much longer that they can see that. Let's see. All right. So we did have a follow-up question. Let's see. GFC versus current, in my meaning, rate staying low during GFC, which isn't the case today. What questions should I be asking of lenders? Chanel, would you mind just on a little bit further on what you're asking? All right, so while you are typing that, so let me go back to screen share real quick. All right, so now let's kind of play this out, right? We've analyzed some markets. We have an idea of maybe where they have been in this cycle. Now we're trying to do some projections on where we think they're going. Right, Bo, you alluded to a couple of tools, including economic-based multiplier, job growth, which obviously means, right, as jobs come in, that normally creates demand. And so it has to be filled with either existing supply or new construction. So, Bo, from your perspective, why is it so important as you start to kind of move down from macro into more of a micro viewpoint? Why is understanding different elements like supply, demand, absorption, vacancy, rent growth, or lack thereof, why is that kind of your second step as a critical review as you're beginning to analyze further?
Well, I mean, it gets totally back to risk. Like every property you ever underwrite and consider investing in lives in the context of the market that it's in. And so all of those things you just mentioned, supply, demand, job growth, absorption, vacancy rates, all that plays in. It's all going to affect the property you're looking at. And so you never want to just underwrite the property without looking at the market. So that's the data you need to make good decisions. But, if you think about one job, if it's a basic job, if you've had 102 and you understand a basic job has a multiplier to it, which creates non-basic jobs, those people have families. They got to come from somewhere. And so if you can predict job growth, you can predict population growth. If you can predict population growth, you can predict demand for all types of real estate.
Okay. So let's play this out in real time for just a moment. Let's say we've picked a market. Let's say there's somewhere in hyper supply heading down to maybe a recessionary cycle. And, that's kind of what some market cycle guides have indicated. You start to look more detailed supply and demand. So let's say that you have negative absorption. Your vacancy rates are increasing. Rates are declining, but yet there was a big announcement made that in the next 6 to 12 months, that particular city is in negotiations with a major employer who would bring 1,000 jobs, right? But I'm looking to buy today, and there's some news speculating that there could be a major employer coming online in 6 to 12 months. How would you analyze or underwrite a deal today based on what could be quantified as a rumor?
Yep. Well, the process of actually quantifying the potential demand if those 1,000 jobs materialize, like you can model that out as a best case scenario. Okay. You can see what that would look like. If I need to buy the property today, like you don't ever buy on a best case scenario. And so I'm going to have to like, you would just simply model out scenarios. But if it doesn't materialize, it still has to be a good deal.
Right. So
I
kind
don't know
of
if that's exactly what you were asking, but
no. So I think that's what's always interesting is that I see a lot of investors who will make corrections to their underwriting based on speculation. I've seen especially on the development front where nothing actually is happening yet, but there's a perceived perception that this area is undergoing or will be undergoing change. And as you guys think about your risk levels and your investors, right, appetite for risk, anytime there's speculation, it's still kind of a crystal ball looking forward. I'm speculating. And so I do see a lot of mistakes made where we might be in hyper supply, a recessionary market. Even the active day-to-day indicators aren't looking great. But because of this news that hit the market of discussions of Amazon, right, looking at building a couple million feet, which then creates jobs, it's going to need additional housing for those employees. I've seen folks start to make adjustments to their underwriting based on this speculated information. But what happens if it doesn't come to fruition? Now I have bought an asset that I am forecasting continued growth and increasing, yet if something major never happens, I'm in a pickle. So I always like to look at more of like have that information in your back pocket, but those speculated items should not drive the decisions you need to make for sound investment underwriting. Continue looking at the cycles, looking at supply and demand, looking at the fundamentals, underwrite accordingly so that you have a good deal or a great deal in tow, assuming the worst case continues to dip down into recession as we head to recovery. And then if those speculated, employers do come to town, you are sitting in a really great spot versus, uh-oh, Amazon's not coming. They chose a different market. What am I going to do? Right. And I think there's been so many major disruptions and announcements between tech companies moving to different states, analyzing economic development folks are great at kind of painting this pretty picture of all the different employers that we're talking to and all this growth that's occurring. But yet it's always amazing. It seems like one major employer have identified three markets. Oh, we're going to get it. We're going to get it. And then it's like, oh, they went somewhere else. And so if I'm an investor and I underwrote accordingly, not good. So I guess that's a great question of, so mentioning back, so negative absorption, vacancy rates increasing, low to no rent growth. But if I do in fact have an employer who has solidified this location, there is new job creation coming, right? But what tools would you use to forecast, right, where fundamentals could go? Or would you continue to underwrite based upon sound methodology and still knowing that as these new jobs come online, it just puts my asset that much more competitive over another? What would you do?
yeah. Well, anytime there's a job announcement, I'm going to model it out just to see what could happen. And as that solidifies, and the main tool that I use to do this is economic base analysis. It's a big part of what we teach in 102. Spend like a whole day on it. But this is where you start with a job announcement and you figure out, is it category A of jobs or category B of jobs? If it's category A of jobs, those jobs will throw off other jobs. There's a multiplier to that. So 1,000 jobs can become 4,000 jobs pretty easily if it's in category A, what we call basic jobs.
Mhm.
And those people, there's an average household size that you apply to those employees to get from total employment, potential total employment growth to total population. Then you see what their salaries are going to be, and you can start to see, okay, how much more disposable outcome is there going to be in the market? How many more housing units do we need in the market? How much more office space do we need in the market, industrial in the market? Like all that you can model out. The firmer that gets, the more you can actually build that into your underwriting. Yeah, to your point, you want to stay away from speculation. You want to stay away from anything where everything has to go right for this deal to work.
Yes.
And investors get deal fever, man. And you want to figure out a way to do the deal because, there's that adrenaline rush, that high of doing a deal and actually owning something. But man, if everything has to go right for the deal to work, like you want to run from that deal.
And I think a lot of that comes back to experience. I mean, if you've only ever been in a cycle that started at the bottom and you've been riding this wave for the last 10 years and you've never felt what it feels like to have a deal go sideways, anyone who has ever gone through that in their career will tell you, oh my gosh, I would much rather turn a deal down to deal with the nightmare of what comes with a bad deal, right? Now, obviously, there is elements that are hard or almost impossible to forecast. Think about COVID, right? I mean, the last pandemic we had was, what was it, 1912, like the Spanish flu?
Yeah, maybe 1918, I think.
Okay.
Yeah.
Anyways, a long time ago, right? I mean, COVID was not on anyone's radar. What was that event? 2000, was that 2019, 2020? Right?
Yeah. March 2020 is when the world shut down.
Right, March 2020. So obviously that's an anomaly, but I'd still say that if you still underwrote a deal conservatively and you were still in line with market, not trying to break through the market, right? There's a lot of things that you could do to survive, right? That's one thing versus loans coming due. I misunderwrote. My rent projections were way high. I mean, here's what's crazy. So let's go back to like 2020, 21, 22. It was average underwriting practice for a lot of groups in multifamily that they were forecasting year over year rent growth for the next 5 to 7 years of 15% or higher,
Well, you
right?
can make anything work with those kind of
Oh,
projections.
sure, right? But guess what? How many of y'all have seen just in the last 12 to 16 months major players in the market who have basically are giving assets back? And so you go back and look. So I've seen some questions pop up about loan maturities, how to kind of get in front of these deals. My first suggestion would be to go back and look at different assets that were acquired in the last 3 to 5 years. I will almost, as a betting man, probably project that on a value add component, at least 60 to 70% of those loans were done under bridge financing, which is typically a 3 year term with maybe a couple years of options to extend. So that'd be one place I might start. All right, so let's take a quick pause before we kind of wrap this thing up. Let me stop sharing. So questions. Chanel, hopefully I just answered your question. I would agree. Crexi, Moody's, Site to Do Business. CoStar does have a decent program where they've tracking loan maturities. So I checked there. But like I said, I'd probably take a reverse look back of looking at, certain deals that were acquired in the last 3 to 5 years.
TREP is another good source of that kind of data.
Say that again.
TREP, TREPP. If
Yep.
you Google TREP, like that's what they do. They source that. In fact, all CMBS financing by statute has all that information, like property level financials of any property that's backed by CMBS financing, has to be sent to TREP.
Yep.
And so you can get a subscription, access that data. That's a great way to figure out loan maturities.
Yep.
And
Chanel's had another
and
great question in all caps. Who, which by the way, I love the fact that you were blown away that people would be that dumb. Who would underwrite to 10 to 15% rent growth? Well, I'd say if you've been in the game since 2020 and you've gone after deals that were publicly marketed with major brokerage firms, made it to best and final, I will pretty much tell you, you would be blown away on both institutional, both domestic and foreign, who underwrote 10 to 15 up to 22% rent growth. There was a deal in Miami, sorry, there was a deal in Orlando that was previously used for corporate housing for Disney, and it was coming online as a vacant asset, and it was well positioned in between Disney World, SeaWorld, and Universal Studios. And I can tell you that group who bought it paid all cash, and they did forecast 22% year over year rent growth. And it was an 80 to a $95 million acquisition. So yeah. All right, let's see what else we got.
let me address James's question just real quick, if you don't mind. He asked, how would you model out the impact of various commercial categories in the market where the employer is bringing 1,000 jobs? Well, you're going to quantify it into dollars of disposable income. That's how you would quantify demand for retail. specifically. You turn that demand into housing units needed to quantify for multifamily or even residential housing units. And for office and industrial, you turn it into square foot of demand. So that's kind of how you model it out. If the employer bringing the jobs is the type of jobs that make something that goes outside of the community and brings new dollar bills into the market, then those jobs will throw off other jobs. There's a multiplier effect. So even if all 1,000 jobs are on the campus of the employer, but they're those basic type jobs, they will create more and they'll still bring the retail demand in. They'll still bring in the multifamily demand because these people have to live there. They're going to spend and shop there. So even if it's not like office space that they're taking up, there's still all kinds of other demand that they're going to impact in a positive way.
Excellent point. Excellent point. There is one follow-up question from Chanel, and that was, I guess all cash I can forecast 10 to 15%. So once you understand how different institution funds and REITs work, right, they report to their investors or shareholders. So even if I underwrote, I think on this particular deal, based upon their acquisition price, including 10 to 15% rent growth and an extremely aggressive exit cap, an unlevered return on this deal was somewhere around 11% on a value add opportunistic vacant deal. So while optics at the project level, it was all cash, guess what? I'm probably clicking away at between 6 to 8% preferred interest to my investors who signed up for this deal because I'm probably projecting based on my assumptions, their assumptions, a return of 18 to 20%. Yet if none of that happens, while you may not lose the asset to the bank, you highly underperformed to your investors. A couple things to think about. All right, so as we begin to kind of wrap this thing up, a couple of things, I think we mentioned them. It is, let me go back to sharing. So there's a couple things that we mentioned, different tools, right? We talked a little bit about Site to Do Business. Some of you guys have heard that. It's a great kind of market analytical software to take a look at demographics, heat maps, market segmentation, kind of a good place to start. And then some other tools that we talked about today would have been that integral real estate report, kind of their market overview. Obviously, we would lean on CoStar, Moody, Crexi, other census data, Department of Labor for labor statistics. So there is a lot of tools and data at your disposal. As you guys take a look at that workbook and start to work through it, it challenges you to start thinking about different markets that you're interested in, starting to do your research, starting to break them down on, historically based on a 60, 90, 120-day look back, where is it currently in the cycle? And then, as always, use more than one data source. Challenge a singular data source. Start to pull your own information so that you can, come to a similar conclusion on where you think, based upon analytical data, on where that market is or where it's going. I will tell you from experience that will give your investors a lot more confidence if you can understand kind of the elements and fundamentals that make up different scenarios of where you are in the market, where it's heading, what elements, positive or negative, could impact where the cycle's going. To Bo's point, economic-based multipliers, job creation, absorption, vacancy, rent growth, population growth. There's a number of things to take a look at. And so all of those components are in your workbook. Definitely encourage you to obviously print those off, start working through them. So, Bo, as we start to wrap up, any closing remarks, closing comments?
Yeah, I mean, I think if I were going to mash up everything that you shared with us today, you're really looking at two things, like understanding market cycles as the context of the market, and then being able to quantify supply and demand. And the demand side is a lot easier to figure out than the supply side. And so your demand side tools are things like Site to Do Business, anywhere you can pull demographics. That's your demand side, because people always drive the demand for space. So when you're talking about quantifying demand, you're talking about the people in a market. So that's generally a lot easier. Supply, how many square feet's a market, depends on who covers your market. Like I'm in a smaller market, CoStar's not real great here. but in a lot of places it's going to be better. But the supply side are going to be your places like Moody's, Crexi, CoStar. They're going to give you the supply side data, like what space is actually there, what are rents, what are vacancies, all of that stuff. Tom asks about how do I forecast or model market performance in MOB properties. Again,
Real
that's a
quick,
supply.
for those who may
Yep,
not
go
know,
ahead.
what's an MOB property?
Yeah, medical office building.
Correct.
All right. And MOBs are a subset of office in general, but they can often perform wildly different than the office market in general. So, like most of these big cities right now, office is still kind of in the toilet, but medical office may be killing it. So, again, you're going to have to get your supply side information from sources like CoStar, Moody's, those types of places, or you get it yourself. That's really your two options. You're going to pay for the information or you're going to go out and do the work yourself. Now, if you do the work yourself, you'll absolutely be the authority in the space. Like you can speak with a tremendous amount of authority if you've gone out there and done the work yourself, done the rent surveys, talked to the tenants and the owners and ascertained all that information yourself. Otherwise, you buy it and you got the same information that everybody else has. But same deal. More people, more demand for medical office buildings. I mean, foundationally, it's that simple.
Correct. I would agree. All right. So I know there's a couple of private questions that were asked on where to find the workbook. I'm going to do this right now. So if you guys open up the chat, there was a post that was just made by Bo at 10:05. That is a direct link to download the workbook I had mentioned. Just so it doesn't get missed, I'm also going to post it again. So you got it in two places. All right. So let me reshare just one more time. All right. So you guys know how this goes, right? We got to do a quick 1 minute plug for CRE Investor Coach. Hopefully you guys got a ton of value out of today's session. These are going to be a monthly workshop webinar series moving forward. So please stay in tune. We'd love to continue to have you join us over the next 12 months. And obviously, CRE Investor Coach, we are here to help both new and seasoned investors continue to scale and grow, not in a, cheesy self-guru kind of way that you guys are flooded with, but using known foundational blocks that have worked and been rinsed and repeat over the last 20, 30 years, using, education from CCIM, making it applicable to how it can be engaged in your real-time business. So we would love to talk with you if you guys are interested in learning more about CRE Investor Coach. In a second, I'm also going to plug a link to our website. And so there is a ton of complimentary goodies that you guys can download, 7-day series, sample coaching sessions. So I would encourage you to check us out. We are here to help you guys grow. So let me put that here. All right, CREinvestorcoach.com. All right, Bo, let's see. We have any more questions before we wrap up?
We don't at the moment.
Okay. Any other questions from you or closing remarks?
Look, I think a lot of people on the call, there's a handful of you that I know that I've met before, and it's great to see your names on here. And you're on the broker side. So my guess is most of you on the call are potentially brokers. The mindset of a broker is vastly different than the mindset of an investor.
Oh my gosh.
And the bridge from one to the other, there's also almost a universal desire for brokers to sit on the other side of the table as the owner. And so most brokers want to be investors. They want to be owners. But to learn how to think differently is sometimes a bridge too far to get on your own. Now, I had a dad who was a broker and an investor, and I grew up kind of seeing how he thought on both sides. So I was fortunate in every way in that respect. But for most of the industry, they learn how to generate fees on closed deals and then they're done and off to the next one. And being an owner is an entirely different thing. The thought process is different. The work is different. And just being familiar with you and what you're doing here with CRE Investor Coach, like that's really, I think, the value you're providing is you're helping people learn how to actually think differently so they can transition from one seat to the next.
Yep. And I'll say it's not just for brokers, right? It is for anyone who has a desire to start investing or they have been investing and a lot of our clients are bumping up against hurdles, right? Their acquisition pipeline is down. It's amazing to me how we talked about project level underwriting, but there's a whole other segment on partnership underwriting and making sure that there's alignment between you and your investor based upon work performed, and that you are incentivized accordingly well beyond a fee, right? This is some of those generate or wealth creation concepts. And it's amazing to me how many existing investors don't think about the alignment, don't think about the roles and responsibilities. And like I said, it's years and years of lessons learned, coaching, actual hands-on deals, that can either take you from working with private investors all the way up to the refinement of working with different institutional equity partners. So as you can tell, both Bo and I are super passionate about this stuff. I think we both really kind of dig into the market of being able to, take data that a lot of people overlook and really start to make wise investment decisions based upon market data that if you were simply just paying attention, you could have realized, understood, and captured. So again, Bo, thank you so much for joining us today.
Yeah, man.
Hopefully I can have you back here again. Wink, wink. And so as always, thank you guys for joining us for today's session. Hopefully you found it extremely valuable. If you did sign up to attend, we will send out a recording of this call. As always, down in the chat before we shut this thing down, make sure you grab that workbook, start to work through it. The one thing I can tell you about investors in general is that it's great to have an idea, it's great to have a concept, but with no action taken, guess what? Nothing's ever going to change. So I would challenge you all, take massive action, start to dig in, and just know that if you get stuck, there's a resource available to help you. So don't feel like you got to go it alone, right? There's a lot of groups out there. Obviously, I'm pretty proud of what we've created, but just take action. That's my challenge for you all today. And so, Bo, once again, thank you, brother, for being a
You
part
got
of
it,
this
man.
today. And as always, if you guys have any questions, feel free to reach out. Otherwise, check out CREinvestorcoach.com. Grab some of those complimentary goodies, and we will see y'all on the next call.
All right. Thanks all.
All right. See you soon.